Well, good morning, everybody. As you can hear, we've been having a nice little conversation about, where were you a year ago and the weather here in Vermont. But what we're really here to talk about is the investment performance at the Vermont Community Foundation. And people who have been here before will see a familiar face. And I think this is the one silver lining of all this. We actually get to see each other versus Mike and I sitting in a room looking at a black box, talking to ourselves, and you, of course, on the other side. So it's good to see everyone's faces again. And I'm going to take this moment just to say welcome. We are recording this presentation, and this presentation, along with the slide deck, will be put on our website for future reference. Or if somebody couldn't make it today, obviously share that link to them and let them know where it is. Or if they have questions, they can also send a request to me. We will have the chat up and open. I'll do my best during the conversation that if a chat comes up, Mike, I'll kind of jump in, or people can also, jump into the conversation and ask Mike directly. I think the best way that we can see this working in the past is to make sure we have a conversation, and Mike's always doing a good job of pausing to make sure if there's questions we can dive in. So with that, Mike, I'm going to turn it over to you and let you kick this off this morning.
Thank you, Debbie, and good morning, everyone. It is really nice. It's so hard to find positives in a pandemic, but this is one, which is to see all of you. So it's really great. Debbie's right. It was also hard to look at that box all the time and pretend there were other people on the other side of it. So this is good. So 2020, just to give you the obvious statement, was a really tough year for us as human beings. And I'll limit my remarks just to the area of focus for us in our work with the foundation, which is it was a brutal year for us as investors. And frankly, at the end of the day, I'll show you in a minute, we were incredibly disappointed with the returns of the long-term pool. And, they were up a decent margin for the year. It's quite surprising to say I can't even begin to overstate how disappointed we were with the results. Long-term, we have great results, and actually the results have started to change very quickly here in 2021 and in late 2020. So I'm going to leave you with some optimistic points in a minute. But the reality is that I just want to acknowledge up front that this was not the kind of year that we were looking for. It was not the kind of year we expected from the portfolio. But we're really excited about what the portfolio has done recently and excited about its prospects. And a little later, I'll give you some of the details about what's different about this portfolio than some of the other traditional portfolios you might see, and why this portfolio has a lot of huge innate advantages on a go-forward basis. So very strong long-term outcome, very dubious short-term outcome, and a very strong long-term prospects is, I think, the best way to think about the portfolio. So with that said, it was, I'll show you in a second. Whoops, I'll get my Zoom thing to work. There we go. It was a fascinating time. So just to give you some level setting here, I mentioned how disappointing. You can't see a lot of disappointing results on this page. The disappointing point I made earlier was the long-term pool was up. It's going to be finished the year up around 9% for the year, which again, in March of 2020, if someone had told me that the pool would be up 9%, the word disappointing wouldn't have really entered my head. But given that the stock market was up 16, 17% last year, the 9 does not feel particularly satisfying at all. Actually, it's not. And as you know, we have a long-term record here of beating benchmarks because beating benchmarks is essential for preserving the value of your assets in real terms and the foundation's assets overall. So there are no prizes for just getting a decent return around here, and that's not our goal. It never will be. We're not always going to win, obviously, and have great returns every year. That's not part of the strategy, I'm afraid, but we nevertheless are very focused on it. So what you're looking at here are the various pools that we've talked about before. The long-term pool is the most kind of unfettered endowment type strategy. The socially responsible pool, which actually has done a lot better recently than the long-term pool, we'll talk about that in a minute, is actually a pool that's very much long-term oriented as well, but it also applies ESG, an ESG framework, a screening framework, and also is aligned with the foundation's values very directly. The long-term pool is not misaligned with the foundation's values, but it's not as there's the less intentionality there. It's much more of a broad-based pool where we think about alignment, but we don't necessarily insist upon it in every single investment. So I think that's something that we think about quite a bit. And then the midterm pool is just as it suggests, it's for shorter time horizon assets, i.e. your philanthropic time horizon I'm referring to. So it's got more bonds in it. And that's why you'd expect in a strong period of time, it will underperform the other two pools. So let's focus in on a few of the numbers here. There's a lot that we could focus in on, but I'll focus in on just a few. I'm just going to shrink you guys so I can see my screen. The first thing is just to look at what's happened since March of 2020. And this is an 11-month period. And you can see the long-term pool has already begun the process that I've referred to earlier of getting back to its kind of getting its mojo back, for lack of a better word. So it was up almost 37% over those 11 months. That was, 4 percentage points above the long-term benchmark, which we think about a lot. But where you can see the disappointment in that 1-year number, even though we like the 18% gain. So that's the year from February of 20 to February of 21, just to be clear, not the calendar year. And it was behind the benchmark by 2.5%. So that's the kind of thing that no one in this call or in the foundation has ever grown accustomed to. And we're not suggesting you should grow accustomed to it. We will recoup that shortfall as quickly as humanly possible. 5 years, because of the shortfall, you'll see we're matching the benchmark, but then 10 years, 15 years. And since we were hired in 2002, significant premiums to the benchmark. And that's incredibly important. The CPI plus 5 is listed here too, because that's the ultimate goal. We do want to outperform the benchmark, and there's lots of reasons that that's important. But at the end of the day, what we really need to outperform is CPI plus 5, because that's the concept of preserving intergenerational balance, and it must happen over time, and it has happened here over time. And we'll talk a little bit more about that later. The socially responsible pool, you can see, actually has no such issues with the benchmark. It's been really doing a great job. I'm going to show you a graph a little later to show you how inconsistent these things can be, or cyclical is probably the right word for it. But nevertheless, this pool's done really well. Now, it's done better than the long-term pool in part because it has more equities. It's also done better because the ESG framework and the values alignment have kept us out of some of the cyclical sectors of the economy to a certain degree. And so that's allowed this pool to have what we call a little bit more of a growth emphasis, growthier sectors like tech and healthcare. And that's been a really important part of its success. But I do want to make it clear, a lot of screened portfolios in the ESG side are very growthy. This one's got balance, which is important because especially as the markets have turned here in early 2021, the pool's actually continuing to outperform, whereas growthier strategies are underperforming significantly. So it's very important that we keep balance in this portfolio. But the point I did want to leave you with is that it's done better than the long-term pool because of its equity exposure and because it actually does have less of that cyclicality in some of the kinds of businesses and industries it owns. And last but not least, the midterm pool's basically been kind of matching to slightly below the benchmark. The single biggest reason that pool will underperform, because it's all in index funds, is that we do use some shorter term bonds in there. And that basically has been very beneficial recently as interest rates have started to rise, and we'll talk about that later. But nevertheless, longer term, the bond market's been an incredibly great place to invest, incredibly scary in some ways because rates just kept dropping and dropping and dropping. But nevertheless, that's what's keeping it, holding it back short term. That's incredibly short term and cyclical. And we will recover even that 0.7% difference you can see over 5 years. I'm not really worried about that. So the next slide. If you look at those graphs before, I'm going to go back if I can. I hope my slides work yet. So these numbers, the 7.1 versus 5.9, the 7.5 versus 6.2 that you see at the top of the page, that looks good, but it's really important to think about it in terms of what it really means. And so this graph takes all those numbers I showed you earlier and essentially says, well, let's look at the cumulative returns. So that very first column, and so cumulative means not per year. So everything before was per year. And it's all net of investment management fees, by the way. So this is the same 4 bars. What we're doing are lines of columns we had before. Lines, excuse me. So what we're doing here is saying, well, what are the cumulative returns? So the 1 year and the since March 2020 are the same, right? There's no cumulative to that. Those were not annualized or per year. But 5 years, 10 years, 15 years, 20 years, here you see what happens if you just compound the money, which is what actually happens in the real world. It really matters. And those small differences start to look much, much more significant. So the couple of things I'd like to leave you with here is, one is, first of all, the underperformance that I spent quite a bit of time talking about a minute ago on the first page is interesting, but it looks kind of irrelevant on this page, mainly because it's just smaller numbers. And as you get out to those bigger bars for the longer periods of time, the outperformance of the pools has actually mattered a lot more in terms of its significance. And that's an important perspective to have, which is why, while we'd like to outperform every year, we're not going to sacrifice long-term returns in order to do that. And so that's why we're willing to tolerate some short-term embarrassment by underperforming in pursuit of long-term excellence. And that's really what this graph helps you see. And then the last thing I'd like to point out on this graph is, let's come back to the CPI plus 5, which we'll talk about some more later. But you can see a few things that are important here. One is that both the socially responsible pool and the long-term pool have outperformed the CPI plus 5 over every single time period here. And I think that's an incredibly important thing. And at the end of the day, that's where we do take, and I know the foundation and takes a lot of pride in the fact that this portfolio has delivered what it needs to deliver to support your work and support the state from a philanthropic standpoint. And I think that's, that's clearly what Dan and Debbie are very, very focused on. The second thing I would point out about this graph, which is interesting, is that when you look at the 5-year period, the 10-year period, the 1-year period, the reality is that it didn't actually matter that much that we were better than the indexes. The index also outperformed a CPI plus 5. But now take a look at 15 years. The green bar is 60-40. We've switched the index to make it simple. 15 years, you can see the 60-40 index fell short of the CPI plus 5. That's the green bar compared to the orange bar. And the same thing since 2002 when we started. Yet the foundation portfolio, the blue bar, the long-term pool, outperformed just barely over 15 years CPI plus 5 and considerably over the 18 plus year period. We're showing here almost 19 years now to the far right. So I bring all this up to say that when we look ahead, which is the last thing I'm going to leave you with in this call today, the question has to become for everyone, can I get to CPI plus 5 with just the indexes on a go-forward basis? And there's reasons to be doubtful about that, which we will talk about a little bit later. And that's where the strategy of being different that the foundation pursues, despite some short-term losses relative to the index, really does matter, because we can't have our blue bar fall below that orange bar. That's a really, really big problem for us. One last thing I forgot. Why does the socially responsible pool disappear after 10 years? It wasn't around. I think I started about 12 years ago. And so that's why the pool doesn't have a 15-year number. There was no socially responsible pool at that point. So let me just pause. And Debbie, are there any questions so far?
No, so far there's nothing in the chat, but if people do have a question, you could unmute yourself and ask the question. If not, we'll move on.
I'll keep moving. I know it takes people sometimes a little time to get their chat function working and their mute button working. So in the meantime, let's talk about, I mentioned earlier how the socially responsible pool has been much more pleasant set of outcomes than the long-term pool. And so we wanted to give you some historical perspective on this subject, which is really interesting to think about it. So what you're looking at in this graph is the blue line is the long-term pool's return compared to that 60-40 index I showed you earlier, which was 60% global stocks, 40% bonds. And you can see that when the blue line, is above 0, it's outperforming the 60-40, which, by the way, these are rolling 5-year time periods back to December 2006. So by the way, that was the answer to the question before. We started in 2006. Because that's when the socially responsible pool started, forgive me. So that's why we started then. And these are each dot in this graph essentially is a 5-year period. So that first period it says November 2011, because that was the first 5-year period starting from December 1st, 2006. And then you can just go across the page and see what the 5-year return looked like each time compared to the benchmark. Now you want to be above 0. That's the key thing. So the long-term pool, you can see, spent most of its life above 0. And then you see that gigantic plunge at the far right. That's pandemic hitting, and you can see the recovery, by the way, which is nice to see that blue line coming back very quickly, although it's not back to where it needs to be by a long shot, but we're getting there, and that's cause for optimism in our view. The orange line, though, or red line, depending on your color scheme, I think it's orange, basically is the SR pool, so socially responsible. It's the same exact set of measurements, and you can see back in 2012, 2013, 2014, we were actually having a very different conversation, which is, why is the socially responsible pool not doing as well as the long-term pool? And the answer then is the same as the answer today. Well, it had more stocks. It wasn't always profitable every single year there to have more stocks. It also does have a more limited mandate in terms of the choices we can make around the investment universe, because there are investments that are neutral, let's call it, to the foundation's values. And we, again, want the socially responsible to be actually well aligned with the foundation's values. And so we're not going to do neutral things. We're going to do things that are impactful. And so that leads to differences. But I mentioned at the time, I wish we had a recording of 5 years ago, because I hope it would have said, at least I'm sure it would have said this, which is that I would have said at the time, this is cyclical. The socially responsible pool is an excellent portfolio. It will have its days in the sun. The long-term pool will have its days in the shade, and that's just how it works. And now you can see that there was a period in the middle where they were about the same on a rolling 5-year basis. It was quite idyllic. They were both beating the benchmark by nice margins. We were thrilled. And then you can also see what happened next, which is that this long-term pool started to slip compared to the socially responsible pool. And a lot of that has to do with, again, the portfolio strategy I mentioned earlier. The socially responsible pool has had some innate advantages over these last few years, and that's what's showing up here. The message I do want to leave you with is the blue line will catch up again and will exceed the orange-red line. And then if you go out 10 years from now, we'll look back and say, oh, look at that. The socially responsible outperform for some of those periods. And so they're going to switch back and forth. And our goal, as you might guess, going back to the very beginning, is both pools need to beat CPI plus 5. Both pools need to beat their benchmarks, and then we'll be happy. I saw something come up in the chat. Is there a chat, Debbie?
Sorry, I got to master my unmute. I guess there was a question about, as we talk about the SR pool and the long-term pool, we have also the number of assets we have in each pool, because we still have a large, right now, I think all total assets for the foundation is almost 400 million. And in these two pools, the long-term pool is running about 190, 185 million. And the socially responsible pool is around 90 million. And that's been growing lately. And that's been growing since 2006, as Mike mentioned, when we first started it. We had a few fund holders in there running about 10 to 12 million. And then more recently, it's been growing based on the awareness that our fund holders have. And as Mike mentioned here, right now, from the investment performance, it's also doing a strong returns as compared to the long-term pool. But as Mike mentioned, there's a cycle there. So Mike, I'm not sure if you wanted to add anything to that, but I just wanted to set some context on the size of the portfolio.
Nope, beautifully said. Couldn't say it better myself. So I will move to the next line. Thanks, Debbie.
Actually, Mike, one other question just popped
sure.
up. There was a question on the SR pool. Is it a fossil-free pool? Then also another question on the composition of the long-term pool relative to the benchmark, if there's any difference there on the asset allocation. So maybe just talk briefly, just to set the context again on the benchmark of the pools and how we see our performance compared to what's the underlying benchmark. And then in the SR pool, do we have it be fossil fuel free?
Yeah, so I'm going to come back to the asset mix in a minute, if that's okay, because I have a slide that I'm going to go to.
Perfect.
And so Debbie, so the answer is yes. The SR pool is focused on climate change as one of the core values of the foundation. So it avoids businesses that are bad actors in the fossil fuel industry. So there is, SR pools and ESG investing are fascinating topics. There are clearly good reasons for divestiture. There are also good reasons for engagement with companies. And so we do actually, SR pool does own some fossil fuel businesses. However, those ownership interests are accompanied by managers who are being activist with regard to convincing fossil fuel business companies to invest in alternative energy, to disclose the risks to their businesses to investors. So there's an engagement strategy involved too. So there's no sit back and own fossil fuel companies, not worry about it type of attitude here at all. But there is a focus on activism. And that will be an increasingly important part of the strategy going forward, I have to tell you. And there's also a focus on, we have a manager in the portfolio who will not ever own a fossil fuel business, but even goes a step further and actually owns other businesses that they think are being incredibly responsible about climate change. And the way they measure that is whether or not these companies use the price of carbon in the projects that they engage in. So you can talk about, for example, they don't own them today, but they used to own Disney. And one of the reasons they own Disney, which has its own issues, of course, but Disney actually is extremely responsible about the way they do projects in their parks and measuring and actually accounting for the cost of carbon in these projects on a long-term basis, and it's how they make decisions about how to design the projects, which tend to be therefore more energy efficient based on that thought. So there's a lot of interesting aspects to it. And I think that's part of the problem when you start talking about ESG and SR pools, is that it's easy to say, well, I'm just not going to own anything. And you want to do that to a large extent, but there are other steps. And I think a lot of investors, including the Vermont Community Foundation, really want to be thoughtful on, well, how do we actually have an impact on the world? And this pool is really much geared to that. And we're in the second inning, just to be clear. There's a lot of work that we've just really got going on in a serious way, and it's going to keep coming. I'm looking forward to sharing those updates, and I'm sure Dan and Debbie are too. Should I keep going, Debbie? Is that okay?
I'm on mute. Yes, keep on going, and I'll pause us in the next couple of slides, and I'll do an aggregation of a few other comments.
Okay, great. Thanks. So let's go back to the foundation's approach. So I talked a little about the SR pool specifically right now, but there are there's some governing principles on top of the entire strategy. The first being is that this is a long-term strategy. And the second point, no market timing or changing strategy and near-term outlook. Well, even though I'm, as you heard earlier, not thrilled about that 9% return for the long-term pool. The reality is, though, that the foundation did a lot of things right last year. And the biggest one of all was this, which is to not adjust the portfolio in reaction to what frankly looked like it was going to be a horrible year for the markets or anyone was trying to make such forecasts. And it was one of the most frightening times for individuals. And I don't want to discount that for a second, but I'll just stay on the investment side for a minute. None of us had ever seen anything like this, which is when do you see big companies with no revenue? And so it was just a really, really disruptive, disturbing time for investors as well as individuals. Of course, again, I'm not prioritizing one over the other. But the reality is that it was a really tempting time to make changes and to abandon your long-term principles. And that just does not happen here. It wasn't even discussed because it's not a thing we do. And 2020 just proved to be the exact perfect example of why you don't do such things. And so that's why the strategy is think long-term, don't make adjustments on short-term forecasts or any short-term views. And three, forgive me, this is me speaking about me, not Dan or Debbie or the committee, but the ignorant man's answer to risk is to diversify, and that's what we're doing. So we're very much focused on we don't know what will happen next. We're going to just stay very diversified, which leads to, and this is the question from before I wanted to get to. This leads to the strategic asset allocation strategies of the three different pools, and you see a few important things here. So one is the point I made earlier, which is the socially responsible pool has more in equities than the long-term pool does. The midterm pool has even less. You can see the bond exposures are different. So the socially responsible pool does have more in bonds, and that's because it doesn't have the hedge funds that you see at the bottom for the long-term pool. The hedge funds, by the way, had a tough year last year, but they've had really good long-term results for us. So they've been a productive part of the portfolio over time. Last year was not an example of that. And the last thing I'd point out, the objective here is to keep the socially responsible pool and the long-term pool similar in terms of the level of volatility they have. So essentially think about the hedge funds as serving both as a bond and a stock in the portfolio. That's kind of how they behave at the end of the day, although it's not a perfect correlation by any means. And then the last thing I'll point out, you can see there's a lot more bonds in the midterm pool. And that's because, again, that's a more defensive pool. And that's why we keep it that way. Sorry, I said it was the last thing, but I had two more. We also see 5% in the foundation's, awesome Vermont investments program. That's in each pool, and that's a part of all the returns, and it's been a part of the diversification strategy over time. And the last thing, truly the last thing this time, is that the committee reviews this formally once a year. They are reviewing it this morning. So next time I see you, I expect, because we are recommending some changes to the long-term pool at least, I expect that I might show you a different graph next time, which will show you the changes and then show you the three pools, of course. So Debbie, let me take a pause there again, see if there are questions.
Okay, and we'll make sure I wasn't on mute. So it's a really good question. It's talking about why we're divesting our assets from in the long term, in the SR pool. So basically the question is, are we divesting because fundamentals are dictating it, or are we divesting because it feels good? Because it's that question that goes about not participating in that sector. Does it really make a difference in where companies are going and what they're doing? And I hope I have that question correctly. And if not, the participant, if he wants to jump in and ask, they can jump in. But I was just typing a response. But Mike, I thought maybe you can also share a little bit on that. I think we've had discussions too, like when we look at our long-term pool, even though we're not a screen portfolio, there's very little of our allocation of our assets to underlying fossil companies because we don't think the fundamentals are there. But Mike, I'll let you jump in and go a little bit deeper on that, obviously. And again, the person that asked the question, you can jump in if you'd like to get more clarification.
Perfect. That's a really, really interesting question. So let's go back to maybe just a quick step back for a second, because I think it really helps with that question, which is the term ESG itself, which is environmental social governance. The framework of ESG isn't necessarily a divestment strategy. What it is a account for the risks of bad behavior from an environmental standpoint, a social standpoint, or corporate governance standpoint. And what that means is, and that's why I think that question was really interesting. So if you're accounting for the behavior and a stock or bond is still very inexpensive after you've accounted for that behavior, well, then you could argue that you shouldn't divest, that you should own that stock. So that's kind of the fundamental framework, which is why that question, with the nuance in that question, is really important, which is that doesn't have to be a divestment strategy. Now, what you also think about here, and this is where the long-term pool and the SR pool are different. The long-term pool can then hold, and does hold, as Debbie said, not much, because the fundamentals are challenging in the energy business today, particularly, although the prices are now very low. So that creates an interesting dynamic. But the long-term pool can hold companies as long as the risk reward looks really good. And again, you have to account for the risks that your oil and gas in the ground are not worth what people think they're worth, because you won't be able to tap into them in the future, or the competition from alternative sources. A whole bunch of other things can go wrong for the oil and gas business at this point forward. The SR pool tries to avoid holding those companies unless, like I said earlier, there's an active engagement angle that actually has value. And that's a very purposeful and very manager-driven strategy. The Vermont Community Foundation is specifically targeting that, but we're hiring people who do, essentially. So the short answer, I think, to the question is, there's not a divestment strategy per se in place. There is an avoidance strategy in the socially responsible pool. And in the long-term pool, we end up avoiding it to a large extent, at least fossil fuels, because the risk reward is still a little bit tough today. And we actually do have investors in that pool who won't own a fossil fuel company at any price, in part because they just don't want their portfolios and their results subject to the price of oil and gas, which is yet another element that really affects investors in those sectors, which is you're very dependent on what the commodity price is. So there's a lot to unpack there. And I'm sorry if I gave it too short shrift, but it's a really, really important point, I think, that was made in that question.
I'll respond. That makes sense. Thank you. I guess my follow-up would be, do you guys have a proprietary screen that you use for your ESG?
No. Oh, did I cut you off?
No, I think
No.
you're good.
Okay.
No,
Sorry.
no, I'm good. I was just asking, do you use a proprietary screen that you develop in-house, or are you using something that's provided outside?
Yeah, you're onto an incredibly important topic. I'm going to give you the short answer, and I'm looking forward to talking about this later this year. So right now we are using an outside third-party service. So we're using MSCI's software, which is the old KLD system, Socrates system. So that's how we score or monitor portfolios. With that said, there are two other elements that are important. The first being that we also on our team are doing ESG analysis of all managers. Like, where is their intentionality? Are they activist, for example? Have they signed the UN PRI principles? There's a whole bunch of different things that you can look at to decide whether somebody's really thinking about these issues. And I would tell you that I'd like to think that as we get through everybody, if there's a manager who doesn't think about ESG, they probably shouldn't be managing money, because it feels irresponsible to me not to even consider the risks of these items, even though they're not traditionally viewed by an investment analyst. And then the last thing, reason I'm kind of excited to talk about this later in the year, is we've just decided in the last few weeks to focus this year on creating a proprietary data set. And obviously we're going to buy data from different people, and we really want to, because one of the challenges we have with the third-party data providers is they give us conclusions, and we're not always sure how they got there. And sometimes when you peel the onion back, it's like, oh, that's not exactly how I'd like to do it. So it's a big undertaking, as you know, which is why I'm not making exactly a promise on how long it'll take, but we're really committed to it. We just hired a new person to run our ESG effort at Crucial, and she's, I think, really going to take us to the next level in terms of doing more proprietary work on scoring trends in portfolios, et cetera. So that'll be really exciting. I'm terrified that we're so ignorant that we're going to get it wrong, or we don't know how big a mountain this is to climb. But I think we're going to get there, because I think we have the right kind of mindset and we have the resources to do it. Okay, I'll jump ahead, recognizing we're still good on time, I guess. So I also want to talk about the managers a little bit. One of the things that's obviously been a major factor in the world over particularly the last 5 years and even 10 years is that, the reality is that for most people, hiring index funds is the right answer. Active management has not been successful. It's been unsuccessful for two reasons. One being that it's hard to win. The studies that are out there say that somewhere between 80 and 90% of active managers don't outperform their indexes. We actually set a very high bar for active managers. So just to give you an example, on our team, if you worked at Crucial and you were an analyst, one of the things I would tell you is, well, if that equity manager you want to recommend to our clients can't outperform by 2% per year net of fees on a long-term basis, don't waste our time, because we're not interested in people outperform by a little. So if you actually took that bar, and we haven't done the math, but I'm going to make a guess, if you took that bar, so well, you only can use managers who can outperform by 2% per year net of fees, you're probably talking about a 3 to 5% probability of finding successful managers. So that's a really, really, really tough thing to do. And that's something that people are justifiably focused on and leads you to the index. The second thing that happens to people who use active managers is they also tend to have, frankly, terrible timing skills. Active managers look really smart when the markets are in their favor, and they look really dumb when the markets are not in their favor. And there's a lack of ability to kind of be patient and to believe in the strategy long term. It's just what happens because it's frustrating. You look at a manager who's the index is up 9 and they're up 6 or 5 per year, and you say, well, why am I paying these people % a year to lose, to basically fall short of the index, and you dump them? That's what people do all the time. And then they go out and they hire someone who's up 14, and then suddenly, boom, they reverse course, and you just continue to kind of stab yourself in the chest with a knife. And so it's a really, really big problem. And actually, if you're not able to be patient with investors or managers, you really should be in the indexes, because that's the only way you have a shot at keeping up with the indexes, frankly. Now, the foundation I showed you earlier has outperformed its indexes over time, its custom index, which is really important, and the 60/40, which is different. And that's occurred because of some advantages that we have. The first is that, obviously, the crucial team now is actually, there's 20 people on the investment team, give or take, whether I count the ODD team or not, which is operation due diligence, by the way. And we go all around the world and try to find the best investors. And we reject 90% of the ideas we look at. We don't even look at a whole bunch of stuff that just looks like a complete waste of time to us. And we spend a ton of time trying to find these great investors, because if I showed you earlier, if you can add value with active management, and you can do it by also lowering your risk along the way, which is another benefit of active management if you do it right, you can really generate significantly better outcomes for all of you and for others who have donated their assets over the years to the Vermont Community Foundation. So if you work for us and you were an analyst, here are the 4 things that we think about right up front. First of all, returns are always accompanied by risk. So if you're going to outperform an index, you got to be different than that index, and that risk is going to be there. And our job, when we go talk to the investment committee and Dan and Debbie, is to tell them exactly what those risks are and why we don't think that they are so important that we should avoid a situation. The second point is we must know the strategy, know the key people, and avoid needless complexity. So if something is really complicated and you can't explain it to me as an investor or a manager, then we're not interested. I need to be able to understand what it is exactly you do and how you do it and why you do it. The old days, which I hope will be soon again, the only one way to do this, which is get on a plane or a car or a bus or a train and go to people. We have managers we recommend on 4 continents right now around the world, including obviously ours. And so we go out and just scan the world and find as many people as possible that are great. It's a small group, but it's a great group. And we've spent, I've been at Crucial now for 35 years. And so we spent a lot of years finding these people, and you build up accumulated knowledge. Third point, I mentioned operation due diligence before. This is one place we do not take risk. We have now our team of operation due diligence people is 3. It's going to 4 soon. And they look at literally everything and make sure that the Vermont Community Foundation's assets are in safe hands. There'll be no Bernie Madoff issues or frauds or things of that nature, because you make sure if the belt and suspenders are truly there and you can verify everything, the assets are safe, and that's very important. And then last but not least, it's a forward-looking process. So if you look through the detailed reports, you'd see that we have managers that I say are great, and they don't look so great right now. And so the question becomes, well, will they be better again in the future? Because if they are, okay, we can be patient. If there's just a terrible idea, Mike, because you do get it wrong, then let's get rid of them. And so everything has to be forward-looking. So again, you can't make decisions based on investment firms based on just looking backwards. It has to be both ways. And I think it's a really important concept. I'm going to jump by this screen. If you had the good fortune to work with us, this is a small sample of the things that you would look at as an analyst and have to write about and talk to the team about on our daily calls. So let's switch to the thing that keeps me up at night, not so much for the Vermont Community Foundation portfolio, but it's a fear I have for what might be going on in the next decade for the philanthropic sector as a whole, which is there's a huge dichotomy in the world right now, which is that if you have the ability to withstand some short-term disappointments, the kinds of ones I've talked about here for the long-term pool, we have never seen a better investment climate in terms of really, it's getting better. It's a little bit worse today because the markets have risen, but really inexpensive companies that are clearly going to be fine in the future with great balance sheets, great management teams, and a little bit of growth even. And they're trading at prices that imply really high forward returns. I mean, that is just incredibly exciting. If you spend time like we do talking to particularly value managers who've struggled so much in the last couple of years, some of them say this, a lot of them say this thing, which really grabbed my attention, which is, we have never, this is the quote, we have never been able to buy such a high quality group of businesses at such low prices. Because if these businesses are not exciting, no one wants to touch them these days. And so it's really, really interesting. And it's one of the things that gives us great optimism. The other side of the coin, and I hate this expression, so I'll try not to use it, but the companies that have done well because of the pandemic, who will likely continue to do well because the pandemic is shifting. You know, we might be on Zoom for a long time now, not through the phone calls anymore for these calls, for example. You know, there are companies like Zoom whose businesses have gotten materially better and probably permanently better. But the reality, though, is that a lot of the market pricing of those businesses today is beyond ridiculous. They're pricing businesses at huge valuations, and these businesses can't possibly grow into those valuations. And so they're going to prove, unfortunately, to be really bad investments, no matter how good the story is. And that's the problem people frequently have with investing is there's the story, and then there's the valuation. And the story and the valuation have to be aligned, or better yet, the valuation has to be less good than the story. But today, there's a lot of companies where the valuation is way too high for the story. And I think that is a massive problem. And then last but not least, market speculation, which I'm going to come back to in a second, which is clearly at a crazy level today. So let's talk about what makes us so nervous. And this is the S&P 500 is the thing to think about here. So the S&P 500, as you know, is the 500 largest stocks in the United States, or selected by S&P, not really the largest, but S&P selects 500 stocks that represent the US economy as far as they are concerned. And that index, while it has 500 stocks, it's actually not as diversified as you might think, because the weights of the stocks in that index are based on the size of the businesses. So for example, companies like Amazon today are massive. So they are a massive percentage, well, they're a large percent, not a massive percentage of the index. And the top 5 names in the S&P are around 20 to 22% of the index, I believe, today, which sounds like, yeah, that's not that terrible. And that's true, except that it's still 5 names out of 500 name index that are, you know, 20% plus of the index, which is interesting. Now, the issue today is that those 5 larger names, and if we throw Tesla in, which is sometimes 5th, sometimes 6th, we essentially have some really expensive businesses in this index today, and they're the quote unquote, you know, pandemic winners and or the darlings of people who like to invest in these kinds of stocks and don't think about price that much. So what you're looking at here is a long-term measure of valuation. So Bob Shiller is a professor at Yale who came up with this idea of the Shiller ratio. And what the problem he was trying to solve is that valuing businesses is actually pretty complicated. It's not a simple thing to do. So when people just start throwing numbers around, you got to ask a lot of questions like, well, how exactly do you figure out the earnings part? Because you can maybe assume earnings will be much better than they are, or much worse than they are. A lot of assumptions go into this stuff. It's an art, not a science. But with that said, can we make it somewhat scientific? And so his answer was, why don't we just use 10-year inflation adjusted earnings to calculate what the E is? And that'll get us past at least the cyclicality. In an index like this one, there are 500 stocks in there. So we make a mistake on a few, it won't have that huge an impact. And we'll be able to really figure out whether markets are expensive or cheap on a long-term basis. So luckily for us, Professor Shiller is very generous with his data. You can go to his website, I think at least he used to be able to, and you can download every Shiller ratio from 1880. And that's what we did. So my colleague Pete Mitzos, who assists me with this, with the Vermont Community Foundation at Crucial, basically he's a god, and he essentially took literally every observation every month and said, okay, what was the next 10 years return from that point in time, and constructed these buckets you see here. So first point I'd make is the Shiller ratio today is hovering around 35. So that's why we basically highlighted both the 30.1 to 35 and the 35.1 to 40 columns. So the first thing that should make you a little nervous is that there have only been, if you add up those 2 lines plus the one above it, there have only been basically 57 times in history that the Shiller ratio has been this high. And in fact, you could argue it's closer to 34 times in history, because most of that first shaded line is actually below the current Shiller ratio. So it's a really, really frightening time just in terms of these numbers are really high. And then of course, your next question might be, so who cares? So it's high, what's the big deal? Market's going to still do well. And the answer is, well, it tends to matter because investing again is about cyclicality and preferences of investors. And it's also about price and what you pay for things. Pay a lot, get a little in the future. Pay a little, get a lot more in the future. So look to that very last column on the right-hand side of the screen. Here you can see what was the median 10-year future return. So start at the Shiller ratio, wherever it was, what did the S&P do for the next 10 years? And you can see, look at the it's a pretty clear relationship. Lower Shiller ratios, higher forward 10-year returns, higher Shiller ratios, lower forward 10 years return. End of story. And this is what makes us nervous. Look at the median in that orange shaded area, 2.6%, 3.3%. So it's not outrageous to say, well, maybe the S&P 500's 10-year return from here is about 3% per year. If you want to be more generous than I'm being, say it's 5%. Take the maximum over the 120, 30, 40 years of history we have here, and maybe you get to a 5.5% return, you know, if you're lucky. Take that, put 70% of your money there, put 30% of your money in the bond market, because that's the other choice investors have to control risk, and you end up with a really crappy long-term return. Maybe you get a 3 or 4% return per year if you want to be generous. And if CPI plus 5 is an 8% return or 7.5% return, it doesn't take a genius to figure out that we're going to see foundations that invest this way erode 30, 40, 50, 60% of the purchasing power of their capital over the next 10 years. And yeah, they can recover from that, but it's going to take a long time. It's a really, really hard problem to deal with. I see a lot of chats coming up, so maybe I'll stop, Debbie, and see if there are questions you want to throw my way.
I sent you two. I'll read one to you and you can read one as well. One question is around the benchmark, the custom benchmark. What's the composition of the custom benchmarks and how have they changed, if at all, over time? And that one I know we've talked about before, but I think it's always good to kind of go back. And so when people know, here's our returns, and here's what we're comparing to, well, how do we know that benchmark is a quality benchmark? So I'll throw that back to you, Mike, and then there's another question that I will bring back up and read to you.
Yep. So the custom, I went back to this screen, you can see the strategic mix. So the custom benchmark basically says, let's take the foundation's actual asset mix at each point in time and apply a standard market index to it. So the US large mid cap is 11% here. S&P 500 is 11% of the index weighting. For the long-term pool, it's 19% for the socially responsible and the midterm pools. So that's how we do it. And you go down the line, there's literally a market index for every single thing here. The only one which is a little funky is the hedge fund area, where we use a hedge fund index of what other hedge fund managers do. So that's actually been tougher recently, but that's not a tough index. But everything else is something you go out and buy from Vanguard or State Street or BlackRock or whoever you use for virtually nothing. And so this is a really good representation of the strategy. And to the second part of the question, it does change over time. So if the committee today, for example, and Dan decides to move the mix a little bit differently than we have here, it would be not a radical change, to be clear. The benchmark weightings will then change in lockstep with the change in policy. So it's a really, really important measure of whether or not we're actually adding value, both through the manager selection I spent some time on earlier, and also through just where the position of the portfolio sits at different points in time. So if we allow the portfolio's equities to drift up and equity markets do well, there'll be a little bit of a benefit to the portfolio compared to the benchmark because it fixes these weights at the policy target. So that's how it works. I would tell you it's a first-class benchmark. Of course, if you disagree, we'd love to have a conversation about that too.
Okay. The other question was relating back to when we were talking about S&P. And so first question is, and I'll use some of the investment terms, but what if you back out the FANG plus Tesla? And what do you think? And what do you think of his new excess CAPE metric? So I apologize again, David, if you want to jump in there and put a little bit of your own frame on that, feel free to unmute and ask.
Yeah, so the S&P right now, a huge, larger than any time in the past, is now comprised of about 6 or 7 companies, the FANGs plus Tesla. Mm-hmm. So I'm wondering, a lot of that PE is tied to those companies. My first question is, what if you back out those companies? Their moves are having a huge effect on what the S&P does. And the argument I could make is the S&P is not necessarily representative of the market anymore. And so then my second question, which I'll go mute, is Shiller has also developed a new CAPE ratio that takes account of the lower yields, and he calls it his excess CAPE metric. And so I'm wondering what you think of that.
Yeah, David, great questions.
Great questions.
Couldn't agree with you more on the first point, which if you pull out those 5, 6 stocks, although I got to tell you, they're not all the same. Some people might not want to hear this, but Alphabet and Facebook really actually aren't particularly concerning from a valuation perspective. It's basically about Apple, Amazon, and Tesla. Those are the ones. But let's take them all out, like you just suggested. And the reality is that it would be very different. And if you'll permit me, I'm going to come back to another graph later, which I think doesn't directly, but tries to make a point similar to the one that you just made, which is that this is not the market. And I really do want to be clear about this. So where I think we've actually agree. My worry, though, is that when a lot of people, at least what I hear people say to me, is, well, I'm just going to buy the S&P because it's been a great performer for the last decade, and actually be connected to some poor decades, it still looks pretty darn good. And that's it. We're just going to put a lot of my money there, and I'll wait long enough, it'll work. And it will work, I agree. But the fact is, so what we're not seeing people do a lot of index funds X the 5 or 6 top names, because frankly, they haven't performed as well. And so people tend to do that kind of analysis, unfortunately, which is look backwards and make decisions on a go forward basis. But your point though is right. It would be a huge mistake to say that US stocks are expensive today. No, you can say that US index funds like the S&P are expensive today. You can go on and say US growth indexes like the Russell 1000 growth are expensive today for the exact same reason, even worse. But the market is not expensive per se. It's actually fairly reasonable, you could argue, on balance. And so I think that's a really important point you're making. And to the second point, which is something I haven't really looked at, and we haven't looked as a team, Bob's new ratio. Just the very off the cuff comment I would make is the worry I have though, and so let me just explain for those of you who aren't familiar with all these things. The theory is that because interest rates are as low as they are, it makes sense for stock prices to be as high as they are, even the S&P today. And that's the argument. And that's a very sound analysis, because the reality is that you have a choice, right? As an investor, if interest rates are 1.5%, you say, well, I'd rather own more stocks. If interest rates were 4.5% tomorrow, you'd say, well, I'd rather own more bonds because they're safer and I'm going to get a decent return from bonds. And it does affect how people allocate capital. It's a really important thing. The worry I have with a new ratio, though, just to give you the off-the-cuff reaction, is, okay, that's great. But if I then say, okay, well, the S&P is fine now because rates are this low, what happens when rates go up? Then the S&P won't be so fine. And I think it's fair to say, and we would definitely say this, interest rates in the United States are still being heavily manipulated by central banks, including ours. And the reality is that they should be higher today. Inflation is going to run hotter than 1.5%. And there's no reason that markets should be basically demanding us as investors take negative real yields. A negative real yield means that if you take the current yield, subtract inflation, you get a negative number right now. No sane investor, if you really ask them to think about it, would want to own something with a negative return. But that's what we're all doing because we own bonds, including the Vermont Community Foundation. But my point being that the S&P reasonableness is highly dependent on interest rates. Interest rates should be higher. And I don't want to bet against should be not happening. So that's why we'd be a little dismissive of that index. But with that said, I think your point about the market is incredibly, incredibly important. Which leads to two more graphs. I want to be sensitive to everyone's time and also want to leave time for more follow-up questions if there are any. So this is the other thing which has got us a little freaked out, I have to admit, which is this is the Citigroup Euphoria Panic Index. And what this looks at is it takes a few factors that come together. One being newsletter writer bullishness. So, people, if you're an investor out there, you can buy newsletters from people who will either make predictions on the short-term or long-term basis about the markets. And when a lot of them get bullish, that's usually a bad sign because everybody's kind of all in, essentially. There's no one else to come in. It's kind of the old theory about it. The second parts of this, and the third part's even more interesting. The second part is options trading activity. So unless you've been asleep, I'm sure have heard about the meme stocks and GameStop. That's kind of a function. That's a little bit of what option trading activity looks like today. And then the third thing is margin debt. So that's when people borrow money they don't have, use their portfolio's collateral and go out and buy more stocks. And it's leveraging yourself up. So when the index is really high, like it is today, you see that we've drawn that red arrow to the far right-hand side. That means that there's a lot of things that are making people feel really excited about the markets. And, I know it sounds a little bit counterintuitive for some of us, but the reality is that when people get really excited about the markets, bad things start happening. And sometimes they happen shockingly quickly, and not pandemics, but just the market just having a huge, huge wave of extra selling because people start to panic. And that's those panic lines you see at the bottom. So this graph shows a couple interesting things. One being, first of all, it's the beginning of the year. So I'm pretty sure we're not Citigroup customers, so I don't have access to the slide on an ongoing basis. That's why we're showing you an older one. My bet is this index is higher today. Which means it towers even more above the last great tech bubble in this country, which was back in 2000. And this should be scary for people. Now, I will tell you, if you listen to the entire philosophy here, we're still not going to do anything about this, i.e. we're not going to take the Vermont Community Foundation's assets and go to cash. We're not going to cut our equity exposure. And the reason we're not going to do that is because, one, we don't really know how this exactly will play out, and we're not going to give up good returns that we can earn. I'll come back to that in a minute. And the second thing is that we own assets on a long-term basis are incredibly attractive today. So if the path to that return is down first and up later, so be it. And you might say, wouldn't it be better to buy lower? And my answer is, yeah, but I don't know how to do that. And no one knows how to make those kinds of short-term forecasts. So stability and consistency are extremely important qualities in an investment program. So we're not going to react to it. But we are saying to, and the reason I brought this up is it just a kind of a buckle your seatbelts warning? Things could get bad here. Euphoria always disappears. It's just a matter of time. And so just be careful. And that's what we're thinking about from this perspective. So two or three last quick things that are important. I want to go back to this slide. This is the long-term pool, 5-year, 10-year, 15-year, 20 years compared to CPI plus 5. We keep going back to that. And by the way, the other reason we don't go to cash, even though the markets are a little speculative or very speculative today, is that every nickel we have in cash, we know will not earn CPI plus 5. Every nickel we have in the stock market and smart investments, we think can earn CPI plus 5. So that really drives the way we think about the portfolio. The key point being the one I made earlier, which is the long-term pool has been really successful here in outperforming these benchmarks. But the other part of the equation, which is important, is to think about how you do that over time and how much it's important to have stability in a portfolio. So we try to avoid having situations where the portfolio, because it's so aggressive and it's so, basically the S&P 500 will be the example of that right now, you can get a lot of volatility in year-to-year grant making. And so what this looks at is it goes back to 2002 again, and basically says, let's take a hypothetical $1 million fund that shows up on March 31st, 2002. We'll invest it in the long-term pool. We'll invest it in our 60-40 benchmark, and we'll just invest in the S&P 500. Because by the way, the S&P 500 has been fantastic the last decades, crushed the returns of almost anything you can think of. It's certainly beaten the long-term pool over the last decade. Now, my warning, of course, is the next decade could be very different, but let's forget about that for a minute and say the following. We have this pool, this fund, we invest in 3 pools. We didn't add any money to it, and we took out 5% per year of a rolling average market value. And what you're looking at here is what did the year-to-year grant making using that 5% of the average market value look like over time? And the gray line is the S&P, the orange line is that 60-40, and the blue line is the VCF's long-term pool. And what's interesting is the first thing you'll note is look at the S&P 500. We happened to start working for the foundation right near tended to be the eclipse of the very end of a very significant bear market from 2000, 2002. So that's why you see the line going down. But take a look at that $50,000 level, which was a 5% distribution on day one of that donor fund. It didn't actually get back to that level until 2015. So that is just terrible. 2015. That is an unbelievably awful philanthropic outcome. And that's exactly what happens when your portfolio is too aggressive. The Vermont Community Foundation portfolio, which is not perfect either, but generally speaking, trends higher over time. And it's far higher than the S&P was until very, very recently, but it's more stable. And I think that's a critical part of the equation. If we looked as recently as a year and a half ago, it was actually still higher. So this is a really important way to think about investing long-term assets, which is you can't just put your pedal to the metal and just own the most aggressive thing possible. You have to be diversified. You have to think about the year to year and how it affects philanthropy. And as we all know, the fact is in 2020 is a magnificent example of this. When things are bad in the markets, that's sometimes or frequently where the capital is needed most. And the last thing I'll point out, you can see to the far right, there's this period here. I'm not sure you can see my mouse, but the line's kind of flattened out here. And so the pandemic hasn't really had much impact in large part because the fall was very sharp, but also very quick, as was the recovery. So this line is going to probably continue to head higher, which is a really nice thing. The S&P may or may not head higher, of course. So 2 more quick things. So this was the question before about the index, really, really important. And this is, I won't belabor this point too much longer in the interest of time. But basically you can see that when you break down the market in the US between value and growth, the value stuff, and you can also argue a lot of the ex-FANG stuff, is actually, it's not just cheap, it's extremely cheap. And that's why we're actually super optimistic about the portfolio. We do own some technology companies, some healthcare companies. We own those things. We think we own the reasonable ones, but we also own a lot of cheap cyclical businesses, financial companies, materials companies, consumer discretionary businesses. There's a whole list of businesses out there. It's actually a really interesting time for thoughtful investors to be buying stocks because companies are being grossly mispriced on both sides of the equation. And this is why the comments earlier about the market not being expensive are really spot on. That's why it was a great question that was listed earlier. So here's our strategy. We're going to continue to follow long-term principles. So if it turns out over the next 12 months that you really just wanted to own Tesla, Apple, and Amazon, I'll be here apologizing to you again for our underperformance, but we are not about to jump into those waters because we know it's going to end badly for those investors, unfortunately. The second thing is we're going to utilize the advantages this foundation has. So all those long-term returns you saw earlier, those premiums to the indexes, those things happen because we do things that are very different than the indexes. It's a really robust portfolio with a lot of diversification. As I mentioned earlier, we have a very high bar for adding managers. So we're not about to add just mediocre people to this portfolio. And then last but not least, again, back to that euphoria graph, we'll go along for the ride. But we'll do so knowing that the worse it gets and the harder it gets for people in terms of short-term outcomes and volatility, the more bargains that we'll be able to pick up and benefit from. So let me stop there. I know we've run almost to the end of our hour, but if there are other questions, I'd be more than happy to answer them.
Yeah, so feel free to unmute. We have a few more minutes and ask Mike some questions. And always, this will be on our website if you want to go back and look at some of the things and follow up with other questions. Anyone have a question for Mike?
Hey, Mike. Hello, Mike.
Yes.
Hi. Yeah, hi.
Al Carr. I don't know if I heard you correctly. Earlier, did you say that like the property sector, which great value there? Are you talking about the real estate investment trust and whatnot? Or did I miss something?
No, I didn't refer to them specifically, although you could argue there might be something there. That's a really interesting question. I was more thinking about financial services businesses, some other cyclical industries. Although REITs would fit into a cyclical industry and real estate investment trusts. The challenge with REITs, of course, is that it's some of them, and they're getting better now, but they did become extremely inexpensive. There was a gigantic amount of pessimism in the prices for good reason. There's obviously a major shift going on in terms of real estate. But with that said, there could be opportunities there, but that would probably be a perfect example, by the way, where, yep, there's stuff that is really interesting today, but be really careful. If REITs can be leveraged, and if they need things to get better quickly, and then you're an office REIT, for example, that may or may not work out so well. And so I think you have to be really careful which ones you pick and how you pick them. But yeah, there could be opportunities there. But I didn't actually specifically refer to real estate. But we do like, from a private perspective, the foundation is made commitments to funds that do private real estate investing, because there's absolutely a lot of stress in that industry today, depending on where you look. And that is an opportunity to pick up assets at really good prices.
Thank you.
I have a question. It kind of goes along with that real estate. Something that's a real big struggle in our state is affordable housing. And I'm wondering whether or not the community foundation, along with the investment managers, have ever considered getting involved in investing in affordable housing development to, sort of like an impact investing angle.
Dan, do you want to take that one?
Sure. David, thanks for the question. It's nice to see everybody. Many of you may recall, some of you may not be aware, across all of our invested assets, where there's a 5% asset allocation to Vermont investments. It's, we were an early adopter of this idea of place-based mission investments. So that has asset allocations grown over time to be a pretty robust pool of mission-oriented investments in Vermont. Recently, we've put a premium on, as projects that are in downtowns. In some cases, those are intersecting with affordable housing. We've partnered with Housing Vermont. We've partnered with the Vermont Housing Finance Agency and a number of other agencies and organizations around affordable housing. I think, and it will continue to be a piece of that strategy going forward. The question I have right now around that strategy is, and I actually just, the other day asked somebody on our staff to begin to do more research, because I couldn't find a database that really benchmarked where median home price in Vermont was relative to median home price nationally, and the ratio to median income, household income, and in the age of first home purchase. As municipalities and communities across the country right now wrestle with the implications of single family house zoning for equity, intergenerational wealth creation in terms of home equity. There's some things that we might want to wrestle with, and we may be willing to invest in terms of creating space and opportunity for families to acquire home ownership and step into home ownership in a more affordable way in Vermont. So I'd say we've been a part of it as partners with Housing Vermont, Champlain Housing Trust, and others across the state. But it is something we'll be looking at with that Vermont investment pool. Thanks for the question, David.
Okay.
Paul Silva is likely to tell me to just check Public Assets Institute. It's probably embedded in their website somewhere that I can find that information very directly. So sorry, Paul, if I didn't start with your website.
It was a good answer, Dan.
Well, it's at 10 o'clock. I want to say thank you to everybody. There's a few open chats that I'm going to get back to people on. And so look for an email from me. If there's any other questions, feel free to email me at the office or give me a call. And I appreciate the conversation today. I'm sure Mike has enjoyed it much more that we actually have a conversation. We can see each other. So silver linings to the COVID situation, but thanks so much. This will be on our website shortly. And if you have any other questions, feel free to reach out and we'll see you. I think it's sometime in May is our next meeting. Until then, be safe, be well, and hopefully we have some excitement going forward with the world and inside Vermont. Thanks so much for all what you guys do for the foundation. Take care.